Very good afternoon, everyone. Very good afternoon to all the esteemed clients, and a warm welcome to the 12th edition of Alpha Manager Series. My name is Shulin Kamath, and I'm a part of the investment functions team with Incred Wealth, and I'll be the host for today's session. Incred Wealth manages close to 35 odd thousand crores of AUM across 4,500 all HNI, ultra HNI, and family offices clients. We are spread across 50 odd cities and have presence across 10 plus odd countries. We are a part of Incred Group, a diversified financial services firm and one of the fastest growing NBFCs in the country. The newly launched category of products called Specialized Investment Funds, or SIFs as they are popularly called, have been the talk of the town. SIFs combine the best attributes of two worlds, which is the mutual funds and alternative products like PMS and AIF. So while they combine the best attributes of mutual funds, such as the tax efficiency or the ease of execution, they also bring to you the benefits of diversification and the tactical positioning that the alternative asset class like the PMS and AIFs have to offer. SIFs allow the fund managers to participate in derivatives, and that's the most important part. It allows the fund managers to take exposures across the derivatives, so the fund manager can take advantage of the uptrending and downtrending market. Most importantly, over the matter of the last few weeks, SIFs have mobilized close to around 2,000 odd crores of assets in the industry, and it's a product that offers a huge potential to scale up. So on that note, we bring to you the 12th edition of Alpha Manager Series, and the topic for the day is Global Market Outlook and Dynamic Style of Fund Management with our guest speaker, Mr. Sandeep Tandon. It's a pleasure to introduce Mr. Sandeep Tandon to you. Mr. Tandon is the founder and the CIO of Quant Group. He has vast experience of close to 3 decades in the industry and in the capital markets, with stints across GIC Mutual Fund, IDBI, ICICI Securities, and Kotak. He is the creator of Quant's very own VLRT framework, which is the valuation, liquidity, and risk return link framework, along with the predictive analytics. He's the author of Being Relevant, which integrates the behavioral finance aspect with data-led investment strategy. So welcome on board, Sandeep ji. It's a pleasure to have you as the guest speaker of the day. The way we have structured this particular session is the next 30 odd minutes are reserved for Sandeep ji's views, and we can take the Q&A section at the end of the session. The Q&A tab is parked at the bottom end of your screen, so do feel free to key in your Q&As across the session, and we'll be happy to address all of your queries. Over to you, Sandeep ji. Over to you to hear out the take on SIFs and your take on the respective products that QSIF as a platform has launched of late.
Thankfully. So I'll briefly talk about market first. I think a lot of people are very tense and pessimistic what is going on. Last 1 year, people have not made money. So let me give you small background, and from there I will just take it forward. So beginning 2025, we talked about the first half of 2025 will be very challenging, and within that, first quarter will be more challenging, and that's the way it played out. We also mentioned in that thing that by end of this year 2025, that is 31st December 2025 will be significantly higher than the 31st December 2024. We still maintain that view, and with that background we'll say that we are more constructive on India. Now obviously from a longer term perspective everybody can talk positive. Let's focus on next 1 quarter. So that's what we are looking at, because given the volatile scenario which we are looking at, so we just released our note last month, and last 2 months we have been talking about a lot of things has been priced in. So let's understand why we are constructive on the market, and we are 98% investment in the equity at this point in time, except a small cap. Three specific reasons. One, the biggest call which we are making, we're talking about the USD INR pair, the depreciating cycle which is going on for years. We believe that cycle is speaking out. We have talked about in our previous book that in 2025, level of 90, it should peak out. We are in the fag end of that scenario. So either USD INR pair is already peaked out or is the fag end. Okay, nobody can time it exact levels, but the characteristic which is required, and it's a very big call from our perspective that we are talking about a cycle getting exhausted. Okay, that's the first point. And if I have to add second most important point, the FI selling exhaustion also we have seen in the market, which means the intensity of selling which is going on in last many quarters has also peaked out, which is also constructive background. Third, the most important one, the earning cycles have also bottomed out. We have talked about by September 2025, the earning cycle should bottom out, and including the tech one, and we can say good amount of confidence. Whatever earning season we have seen actually is better than the anticipation. Don't compare on YOY basis or quarter on quarter basis, but I will compare on the expectation which got built. Now, additional comfort factor is obviously the income tax benefit which government has given, a GST rationalization which happened very recently, or the interest rate cycle which is coming down, and also look at the background that India has underperformed developed market and emerging market for last many months now and a few quarters also. So the background is more constructive, where people are on the verge of getting capitulated, people are frustrated and tired. These are all classic signs when you get that opportunity. Now, we are not saying that we are in a roaring bull run will start and we are very excited about it. We are saying we are constructive on this market. And very important thing to understand that people should understand that easy phase of bull run got over in 2024. And this is what we have said. We were relatively early to take that call. Market peaked out in between September and December 2024. We took the call in July 2024. And hence, it's very important to understand that though we are in bull run, decisive bull run, but we are in difficult phase of bull run. On multiple show, I talk about this thesis. And hence, the QSIP type of product will be more attractive product in the difficult phase of bull run. So that's a broader sense on the market. In terms of global markets, we have been sounding cautious about gold and silver. We talked about that from a medium-term perspective, they have peaked out, and we said by December, from the peak, they can have potential to correct 25% in dollar terms, maybe in rupee terms marginally more. Because rupee has a possibility of appreciation. Second thing, our concern is not at all India. Our concern is global market, where multiple forums we have been highlighting, and US is area where a lot of complexity got built. Some sort of I am not still in a camp where you can say this is an AI bubble and all those things. Bubble needs everybody has to be sucked in globally, which is not the case right now. So this could be a small trailer, but I don't think this is a sign where we can say this is a longer term talk is in place for US market. So maybe from a medium term perspective, we have concern and it has started correcting. But that's a good news. If global market corrects, and in China particularly corrects, and emerging market corrects, a great news for India because ultimately money shift. So that's a larger perspective on the market in general. Now coming to the SIP side. Okay. Now very important thing to understand what SEBI has recently introduced this concept is a very important thing, because what SEBI has given us as a money manager important weapon. Okay. And this tool or weapon, whatever name you want to call it, it's up to us how you want to use it. If you want to use this instrument or tool in an aggressive manner, we can harm our portfolio or make extraordinary money also, both ways true. Or you can protect your downside, you can reduce your drawdowns, you can reduce your volatility. So we as a house has been taken a conscious call to run this product in a more conservative manner. And globally, these products are also known as wealth preservation products. And various names, we will talk about the long short product or hedge fund product or low balls product, absolute return product, beta neutral, market neutral, various names are available. So now what is important for us to understand from a SEBI perspective? So what SEBI is saying that you can run this product like a normal mutual fund. Answer is big yes. But obviously it does not make any sense if I run like a normal mutual fund, because we already have a mutual fund product. Now, in this product, what regulator also talks about, if you, let's say, are fully invested in the market and you want to now, for whatever reason you are negative and you want to use this option of features of shorting 25% in the market, the first step is being defined. A, you have to cut down your gross long exposure to 75%. Then you can take this short exposure of 25% and hence total exposure is 100, which means as a mutual fund, we are not allowed to create any leverage position. Now, this is an important myth which I want to highlight. A lot of people, when say it's a derivative product, derivatives are risky. Derivatives are a great risk management tool. But if you use derivatives with the leverage benefit, then it works both. You can make extraordinary money, you can lose extraordinary money. So, since leverage as an option is not allowed for mutual fund, and hence it becomes less risky product, rather better risk management product. Now, when I use this 25% hedging option or the shorting option or the hedging, I will say naked short option, which means my gross long is 75, but my net long comes down to 50%. So I have cut down effectively the beta of my portfolio by half. That's a broad understanding, not necessarily mathematically exact number. This is the broadly, if I have to explain you, and hence these products are also known as beta management product. This is what the way we are defining our QSIM. Okay. Three important data points also we want to talk. I'll run through a presentation. Let me just give you some perspective first. In the QSIP, what is very important is that I have seen globally, if you are running continuously long short portfolio, then you have a probability of losing out on both the side. And we have seen with the experience, doing a continuously long short is not a great strategy, and hence we are talking about in India. How QSIP will be used, we will be using as a tactical long versus an opportunity short. In a mutual fund portfolio, really we have, from a longer term perspective, we have a core holding sort of positions. Okay, and then you people do give 20 odd percent as a trading ideas or non-core positions, or we will call it in a different name, or tactical position. We will prefer to call it tactical position. So in mutual fund, you have a smaller portion of tactical positions and remaining are core from a long-term perspective, and tactical or trading obviously means largely from a short-term and medium-term perspective. So when we are talking about tactical position, our entire emphasis in this QSIP as a product is all about tactical longs and opportunity short. We will not running short also on continuous basis. Shorts are always, if you can optimize your short or the inflection points better, then you actually book profit. You can generate alpha out of it. That's a very important mindset one should have. So when we talk about QSIP as a product and we say it's a risk mitigation product, we are talking about systematic active investing. So let me explain you this thesis also a bit. In a mutual fund, we run through discretionary active portfolio, which means, or discretionary active investing, which means the portfolio is complete. The canvas is completely open for a money manager. He or she can decide a call, and there's no restriction. So what is important from our perspective is to understand. For us to understand that the discretion is there, the canvas is open. When we talk about systematic active, basically we are putting what the systematic is. So that means we are creating our own boundaries. When we create boundaries, that's the only way we can control our risk. So it's become a better risk management tool. When we talk about purely from a risk perspective, see, if you leave, let's say when we in a mutual fund, we talk about 5-year perspective, 10-year perspective, long-term thing. It's very difficult to predict 5 years and 10-year risk horizon. When we are talking about managing from a short-term medium perspective, yes, we can predict or can better quantify risk if it's there for few quarters or few months. We cannot say for 5 years this is the way risk will be, but next 4 years, 5 years, the visibility is far higher, and hence purely from a risk perspective also, it makes sense. If I have to generate continuous alpha, then my risk horizon, risk has to better manage, and hence my investment horizon also should be small. And the last thesis, which we talk about, high frequency analytics, if you see on the thing. In our mutual fund, when we run our VLRT framework, we stand for valuation analytics. Obviously, valuation analytics is dependent on a data which is not frequently published or given or shared. Though the company is making profit or revenue on a regular basis, the data is shared only on quarterly or monthly basis, and they are high They are low frequency data. Any analytics which is based on low frequency will be low frequency analytics. Similarly, risk appetite is also a low frequency because the macro data which comes on quarterly, monthly, or half yearly basis. Again, low frequency. L stand for liquidity analytics. Only small portion of liquidity analytics has high frequency like volume, open interest, or volatility data. So some portion of VLRT, 90% of the VLRT framework is low frequency, only 10% is high frequency, and that's the reason in mutual fund we say we run through low frequency analytics. When we're talking about medium term and short term, everything is through high frequency, which I will explain you now. Now I'll run through a small presentation so you'll get a better perspective about the products. Now, SEBI has allowed 7 different types of scheme which we can launch. 3 in hybrid, 3 in equity, 2 in hybrid, and 2 in. We have already launched 3 products, 1 in hybrid, 2 in the equity, and 2 more are in pipeline. Maybe by December, our all 5 products will be launched. Now, since we're talking about here largely a perspective about short term and medium term, and hence analytics plays a very important role. We are first time introducing Quantamine, the internal software which is used for analytic and risk management platform. We have built from 1995. We have invested $20 million in building this analytic platform. First time we are talking about because we felt if I want to talk about high frequency analytics, then people naturally question comes where is the experience which you're talking about. And Esport was built in 1996 with very early mutual funds which we took over in 2018, and hence we have 30 years of experience. Now, what is important for us to understand why Quant is more equipped to handle this product? First of all, the most important thing, India's first high frequency trading desk was in Quant. In our previous avatar, we used to run a very large prop desk in the country. We used to do $1 billion turnover on regular basis in the exchange. And we're the first to get the co-location server also in India. So very early stages, we have played this business on size. We are the biggest facilitation desk in the country. We understand this segment far better than the industry. And hence, we think we have better experience and relevant experience to manage this product. Myself being as a risk manager of a large book, we used to manage 10 years we ran that product. Not a single year was negative, not a single quarter was ever negative in terms of combined strategy. And in the Lehman crisis, we made 18 crore rupees in that 45 days of crisis between September, October or beginning November. So that period we made good amount of money to a fairly good perspective, and our size was very small. So overall mutual fund, we have now 5 years of track record which we have built. Now let's understand very quickly about the few important pieces of question count. 10 lakh rupees is the minimum amount for this product, but it is per PAN per AMC. So if we launch 5 products, you can actually invest 2 lakh rupees each. The starting point will be 5, and then you can bring down to 5 and then 2 resident segregate, or you can do it 2 also, but a lot of systems are not in place to accept that unless we go for physical thing. So ideal situation, you apply for that or you come through website, which we can do that. This is an important thing. A lot of people get confused. Okay. Now, aside as the product is a unique because we are taking a flexibility of AI and TMS, and we are bringing the tax efficiency of a mutual fund and transparency of a mutual fund. And that gives me a huge edge. As I said in the beginning of the presentation, the easy phase of bull run is over and a difficult phase of bull run. These are the products which will take us to the next level, and we are very confident next 5 years is going to be very volatile, very challenging for the market, and product like Houston will outperform mutual fund. Now, we as a house always say a balancing act. We say if you already have mutual fund, then incremental money should go to Houston, because you should, in 5-year perspective, you should have 50% money in mutual fund, which you put in QSIP, so that it will give you better balancing, lesser drawdowns, lesser volatility, and additional source of alpha. So this is what I explain you: tactical long, opportunity short. This is something what we're talking about. 50% exposure to the portfolio. This is the ideal scenario based on your risk appetite. Effectively, QSIP type products are more conservative than a mutual fund. This is something very important for you to understand. I have explained a lot of pieces out here. So we talked about briefly about Quantamine, and this is a product. So I'm not, the presentation is available. I'm just going to touch base on a few important data points. This is what I talk about decreased boundaries when you manage systematic active investing. This is all about active strategy and systematic precision. It will help us in a more in a methodical manner. Now, what is important is that when we talk about systematic active investing, we talk about long, short, we can play both. Theoretically speaking, we can hedge 100% our portfolio and we can also have naked 25% short position also in the market. So that level of flexibility this product gives. We are actually very grateful for SEBI for the mutual fund tax benefit. This product is there is very unique product. The taxation of a mutual fund and flexibility of other instrument take this product to the next level. Now, when we talk about high frequency analytics, something which I want to explain. We have brought a thesis how VLRT got built for mutual fund. We are building Markov for our high frequency analytics, and this is for the systematic active philosophy. Now, when we talk about Markov, is obviously derived from K. Markov, who is a very famous mathematician from Russia, but we are just inspired by the name. We are talking about here market microstructure, which means we are talking to the more depth of the market. You see on the screen or tickers, you see the last prices on CNBC channel. But if you are a broker, you see the bid offer spread. If you are a hardcore high frequency trader, you can subscribe additional data from BSE and you can see the entire depth of the market. So we are talking about more granular analysis or granularity of the market. Instead of saying wicks, I will say wall surface. Instead of saying yields, I will say term structure. I'm getting into more granularity aspect. Second important thing, we're talking about alternative. In the AI world, we can actually do a lot of work on the analytical side. On the alternative data, this is one area we think will go to the next level. We are also expanding, whether we talk about earth analytics, social media analytics, weather condition, or any other analysis we want to do in terms of demographic analysis, various data points. Risk analytics is also an important high frequency parameter where you talk how to manage the Greeks of the options, where we talk about the war number, where we talk about the impact cost, we talk about the liquidity aspect, very important pieces. Cyclical analysis is also important because we tend to analyze, like how I told you, next 3 months looks good to me. Purely on a lot of predictive analytics model we have built. So cycle analytic data is endorsing the next 3 months will be slightly better. That's the way we take a larger call. In today's world, markets are in short term are driven by noise and narrative. And after 6 months, you realize, oh, that was the noise, reality is different. And hence, objectivity analysis is very important. When I say objectivity analysis, let's say Reliance result comes out, 100 people cover the stock, 70 analysts have buy rating, 30 is sell rating. I'm not getting why you have 70 buy and 30 sell. We are saying objectively 70-30. If I want to take to the next level, let's say how many stocks, how many analysts are above the average number or an outlier. So let's say 10 out of 100 people have more than 10% earning estimate differential, and so 10% or out of 100 or 10 out of 100 is my outlier numbers. So something similarly, since we are dealing largely with volatility analytics, options data and the derivatives in a big way, hence volatility analytics plays a very important. These are few high frequency analytics which we have tried to showcase to give you perspective how we'll manage. Now, very clear differentiation how mutual fund is run through VLRT framework, discretionary active 70% high frequency, low frequency 30% high frequency. In SQSET, clear differentiation 70% high frequency, 30%. So we as a house have very clear demonstration of two different products. This is an important slide. You can go through it, which are the whether in mutual fund QCF, what strategy you can allow, what is not allowed, what you can do, or what is the whether it's a low risk strategy, high risk strategy, all those things. We have tried to summarize. A lot of questions come, so you just go through it. Gives you a fairly good answer. This is how we have defined the thesis, how the analytics, how combination of these two products works. This is a scenario analysis how relatively these two products will perform in a different environments. Only in raging bull run and extraordinary environment, QCIP will underperform. And in other scenario like corrective phase, range bound, bear market volatile, this product will outperform. And it's not necessary, but this is the broadly it will happen. So that's better to explain you with some sort of clarity. Now, what is important for us? First product which we launched was the equity long short product. Now you are more familiar with the flexi cap as the option. So it's a flexi cap with 25% naked short. So effectively it means in difficult environment, this will be flexi cap plus. That's the way our endeavor will be. So a lot of people ask this question, how will it? So we have to look at this is flexi cap plus product. And similarly, we just launched last week this product got closed. Equity long short is the SMIT product, basically X100. So in mutual fund also there is no product line with the small and mid are together. So it's SMIT products along with volatility. We can control the volatility of your portfolio. The challenge of small and mid with the high portfolio is high beta. So if you have 25% shorting option, you can generate better returns or control your environment, which is the way we think going forward will be challenging. Now, sector rotation is the last product which we launched. Here we have some challenges because only 4 sectors are allowed. You can go long 2 short sector or 2 short. So some amount of clarity is still missing, which we'll get from SEBI before we launch this product. We already have approval for the same. So this also will come. This is a very interesting product, active asset allocator, where we have a flexibility to play around in all the asset classes. And so you can, let's say gold silver was going very well and we were positive. Also, we were went 30% long silver in our multi-asset mutual fund portfolio. Here I can go to, even the way we have designed, I can go to 65% long on gold and silver, and I could have running a 25% naked short on the equities. So it's a very good product. It gives me huge flexibility as a money manager to really demonstrate your capability on the research side, how well you manage this product. This is the next product. In next 10 days, 15 days, you will hear from us when we launch date of this product. And how we're going to manage? Exactly like multi-asset plus 25% shorting option. Okay. This 25% shorting option is a very unique thesis. Don't look at from hedging. Hedging is allowed in mutual funds. This is a naked short. The inflection point, if you get it right, you will make money and you protect the downside. Hybrid is already launched. We are calling this product a BAF plus, which means BAF is a product you are aware of. How 35-40% equity exposure remaining is hedged, something similar we are running. This is a BAF plus product. This is also launched and running. And debt, we are not in the hurry to launch right now because we still lack that clarity in the debt side. The liquidity is there. I'll just stop it here and I'll open the floor for question answer session.
Thank you. Thanks a lot, Sandeep, for those insights. Quite a few questions have been, logged in by the clients. To start with, usually this is the common query that most clients have, right? So who can consider investments in SIFs, considering it's a relatively new category, right? So there is a lot of
So everybody can invest. I will say it is more apt for conservative player. Okay, because a lot of people I have seen in the market, they come at the peak of the cycle, they have highest risk appetite and they are all long-term vision. In reality, they are not. So it is actually most apt for a lot of players who are not have a high risk appetite. And the ideal combination is that if you already have a large mutual fund exposure, don't add mutual fund exposure, add come to QSIP. That's the way I will say it gives you better balancing.
Yeah. And do accredited investors have the flexibility in the investment amount?
Yeah. Yes. That is for us, it's 10,000 rupees.
Okay. So if the quite a few players have launched SIFs of late in the industry, right? So starting from Altiva to right down to SBI to Tata to Divinity, right? So how do you benchmark your strategies versus all of these peers?
We are very clear. Like I have seen some people talking about hybrid product, arbitrage plus or fixed income plus. That's not our strategy. We are clearly saying it's a BAF plus product. And the rating which has been showcased to risk band is true. We have showcased high risk band because if you're running a long term, you cannot have 2 risk band. It's actually proper risk selling because when your portfolio will be published, it will be on higher side. So I'm very vocal about it because long short product, you can't write a risk band of 2. It's not possible. Okay. Because we don't want to miss selling because after portfolio comes, unless you say I'm going to run FD plus, then you don't need this product. Okay. Any scheme you can convert into FD plus product or arbitrage plus. You don't need to waste this 25% shorting option, which SEBI has given us. So that's our first point. Second one point is that we are very clear. People understand that product very well. Here, a lot of people are trying to say absolute return product. This is not going to be absolute return product, okay? Because absolute return product, you need leverage effect, then you can lock in and then multiply by that. So it will not be fair to say it's absolute return product, okay? If you want to say it's a low risk product and all the presentation which I have seen in the industry, the strategies are not low risk, okay? So I'm very clear, this has high risk profiling. but it is more conservative product because this product you're cutting down your beta and hence you're managing a risk better. Hence a superior risk adjusted return versus mutual fund. A lot of people get confused. Oh, this is a risky product. No, actually, it's a less risky product. It's up to us how you manage. We are going to run as a less risky product.
So for all of the launch SIFs from QSIF as a platform, right? Although it's a relatively short time frame to compare the returns, right? How have your strategies performed within a short time frame?
So as you rightly understand, in any portfolio take 2-3 months to deploy properly, check your system, check your margin. It's a process. I'm not a great believer of back testing. Historically, this work. I believe in real life it happens. What is important for us that our shorting has done very well. Though we have cut down very fast because like how the first trade should not go wrong, psychological thing. Okay, the first trade we shorted Dixon, we made money. We shorted Umber, okay, we shorted Keynes. Okay, so we got that thesis right. So we are very optimistic that we didn't held it for long. That's a different issue, but we cut it very shortly. But we want to also experiment that whatever analytics we have built, whether it's going to work or not. It worked beautifully for us. Hence, we are confident that we can scale up these products. And as I said, it's a high frequency analytic. As data starts stabilizing, see, today is our mindset also has to change the way we manage this product. This is a challenge for the industry. Everybody comes from a very traditional long bias background. We as a house have long short experience, so we are very clear. We're able to demonstrate better. But again, anything which is new takes few months. You have to give few months to stabilize, build a strategy, and then observe. And as anyway, you get 40 trading sessions to deploy. So when a new product comes, people are more cautious and trying to see how exactly evolve. It's an evolving state, but we remain confident. So far, experience has been reasonably good.
Yeah, great, sir. So most people tend to have a very positive view on Indian equities, right? And in line with that thought process, it's they always benchmark a newly launched product with the traditional plain vanilla mutual funds, right? So in the long run, what do you expect? What's the kind of expectation from this category of?
So I said that it is if you, let's say, a long short BAF product or a flexi cap. So it is, if you compare FlexiPel, I will say plus minus 3. If you're doing extremely good job, plus 5. If you're doing horribly bad job, minus 2. That's the way I will define this product because it's the product will not be, the portfolio will not be same, but style is that flexi plus shorting option. So that's the way the returns I will define. So BAF plus, so you are generating slightly better return than the BAF and better risk management. So product wise, a better product.
Yeah. And just a supplementary question to what you have just mentioned. Out of the 3 launch SIFs on your platform, which product has the potential to generate a higher return in the coming 2 years?
So I think the equity long short product gives me huge flexibility. It's a complete flexi. I can make large, small. My universe is very large. Where in SMID, my universe is small. Today, let's say 209 F&O stocks are there. Out of that, 96 are small, large cap, 86 are small cap, and 24 are the small cap, and 86 are mid cap. So when it's a flexi, that my universe is 211. If it is mid, my universe is relatively slightly lesser. The flexibility wise, it's a thing, but again, somebody comes and says, I want to put mutual fund, I only look for small and mid. So it's depending on somebody has 6-year horizon, then I will say go for SMID only. SMID, this long short option is far better product. So again, if somebody has 1 or 2 year horizon, then I will say equity long short. Somebody has a very low risk appetite, then you will say go for hybrid.
Sure. So in a way, are you trying to say that can we expect an alpha of close to around 3 to 4% versus a comparable mutual fund strategy?
Yeah, over a period of time, yes. That's the way it will evolve. That's the way we think we will evolve this product.
Okay. Understood, sir. One question that often gets asked is a targeted kind of an IRR, right? Would you like to give an estimate of the equity long short or maybe the hybrid long short? What's the kind of IRR that an investor can expect from these?
No, we generally don't comment. I have already given you a perspective. Compliance reason they are not allowed to talk. I have told you a fairly good perspective, back plus. So you will get a fairly good, you know.
Yeah, understood.
Yeah.
Okay, so I believe we have answered all of the questions. In case there are any other questions from your side, please feel free to log in your questions. I don't think there are any other questions in the queue, sir. We'll wait for maybe a minute or so in case someone intends to have a query.
ये देखो इन्होंने बेचा है.
So any timelines that you have in mind, sir, when it comes to launching other products? So 3 strategies you have already launched, right?
By December, we will all have all 5 products in place.
Okay, including the debt or...
The debt we are not launching because a lot of liquidity restrictions are there, and we think we are not capable of handling debt right now. Okay, once we have right person, right now that product is not viable. They're talking about shorting on the equity side, on the exchange floor. There is no liquidity out there, so it's not very viable. Also, whatever little bit we have understood.
Understood. I think we have answered all the questions. So
if anything is there, you can always talk to this guy, Surendra, about it, and we'll be happy to address that. Okay.
Sure, sir.
Chalo, you guys. Take care.
Thanks a lot. Thanks a lot for the take. That was an insightful session. Wait for many such sessions in future. Thanks a lot, sir. Have a very good day.